Today's episode is brought to you by S&P Global Market Intelligence. Find insight at every data point with enhanced S&P Capital IQ Pro platform. It's the leading data solution for strategics and investors alike. Discover critical data sets, including coverage of over 54 million global private companies, plus AI-powered tools to streamline your workflow. It's no wonder 85% of companies in the S&P 100 are clients. Learn more at spglobal.com/proinsights. That's spglobal.com/proinsights. Hey, M&A scientists. Let's talk about one of the biggest time and cost sinks in deal making, contract review. Every deal comes with a mountain of contracts, employment agreements, customer contracts, vendor contracts, you name it. Buried within those hundreds of pages are crucial details like change of control provisions, consent clauses. Those are the things you need to get ahead of. Traditionally, combing through these contracts takes hours, sometimes hundreds of hours. But what if we could reduce that time by 80%? With Dealroom AI, you can. Our AI-powered contract analysis tool scans and extracts key information from all your contracts in minutes. No more spending countless hours hunting for risks. Dealroom AI highlights critical clauses instantly. And here's the best part. It's incredibly easy to use. No special training, no steep learning curves, just upload your contracts and let Dealroom AI do the heavy lifting. Think about the legal fees you'll save and the efficiency you'll gain. Plus, computers tend to miss less than humans, so you can trust you're catching every important detail. If you're ready to revolutionize your contract review process, check out Dealroom AI. Because in M&A, time is money. We're here to save you both. Visit dealroom.net to learn more. Here's to the deal. Welcome to the M&A Science Podcast, where we learn from the best in M&A to uncover proven techniques for enterprise value creation. If you're interested in optimizing your M&A practice or want to join our community of forward-thinking M&A practitioners, visit mascience.com and subscribe to our free weekly newsletter. If you want to keep up with us on the go, head over to LinkedIn and follow M&A Science. I'm your host, Kisan Patel, CEO and founder of Dealroom and Chief Scientist at M&A Science. Today, I'm joined by Joe Mantone, U.S. Financial Institutions News Desk Manager at S&P Global Market Intelligence. If you're not familiar with S&P, they're a global financial information and analytics company traded on NYSE under SPGI. Joe's going to walk us through some insights from the recent M&A equity offerings market report and dive into current trends, challenges, and strategies for corporate M&A practitioners. Joe, how are you doing today?
Very well. Yourself?
I'm doing great. Thanks for meeting me over here in Midtown at our office hosted by VRC for providing a space to do our podcast today. If you're not familiar with VRC, Valuation Research Corporation, #1 provider for valuations, check them out. Joe, thanks for taking the time to have this conversation. Can we kick things off a little bit about your background?
Sure. Well, thanks for having me here. It's a great podcast. You guys put out some really good content, so it's an honor to be here. So my background, I'm a trained journalist. I got started in journalism at a pretty early age. When I got cut from the high school baseball team, I realized I wasn't going to play second base for the Yankees, so I started looking around for other options. And I first kind of got into sports journalism, but then pretty early in my career, I started working for business publications, and I've been doing that for more than 20 years now, I'd say. And I got my first exposure to M&A coverage when I was at the Wall Street Journal. At the time, I was working the night shift, and my job mostly consisted of taking articles that were going in the paper the next day and putting them online. But sometimes the day shift would need help And at the time, the Journal had this blog called the Deals blog, and it was run by Dennis K. Berman. I'm not sure if you're familiar with that name, but he was an editor for the Journal who went to Lazard. I think he's at a private equity firm now. But so I helped out for that blog for like a week, and it was a great experience just covering deals for the Journal. And then from there, I joined my current team and started covering investment banks. And what's great about working for S&P Global Market Intelligence is we have a ton of access to data, and we're constantly trying to figure out ways to leverage that data. And as you mentioned, the quarterly research paper that we do on M&A and equity offerings, that's a project that I helped start, and I'm the lead writer for that. And we just kind of look at deal trends, and what's sort of driving the activity. And something else that we do is we put out these annual big picture reports that kind of look ahead for the next year. They're forward looking and look at how what's going to shape the themes that are going to shape different topics for the next year. And for that project, I worked on the M&A paper for the big picture.
So you've been doing this for a while, and you're knee deep in data. And that's what I'm hoping to learn from you, is get a different perspective today. Can you give us like an overview of where the M&A cycle is today?
Sure. Yeah. And to begin with, I look at M&A very broadly. I know a lot of your guests on here are practitioners, and for practitioners, they're in the trenches working on deals, and for them, I know it always seems very busy. But when you take a step back and you kind of look at deals from the totality, sometimes you get a different perspective. Right now, I would say it seems like things are improving from an M&A standpoint, and we've definitely seen an increase in M&A, but it's off a very low base. When we look at the global M&A picture, we're still in the midst of the downturn that started in 2022 when rates started to rise. The current activity is nowhere near the record-setting levels of 2021. At that time, the deal activity was topping about $1.25 trillion, and the number of deals averaged around 14,000. We're also pretty below the pre-pandemic levels. When the deals were the quarterly totals were around $800 billion, and there were about 13,000 deals a quarter. But that being said, we have seen some positives in the data. The second and third quarter of 2024, we saw an increase in the number of deals, and the increase was small, but it was notable because we hadn't seen that since 2020, where we saw 2 straight quarters in a row where there's quarter-over-quarter growth. The third quarter also had year-over-year growth in the number of announcements, and that was the first time that happened in 10 quarters. So, and I'm talking about the third quarter because the fourth quarter there was a bit of a slowdown, with the U.S. election. That but I kind of think that it was more of a blip than anything else. So when we take a step back, I would say look at the activity where it's increasing. We're nowhere near the top of the market. There's plenty of room to grow, but we're definitely moving up off the low point, which kind of looks like right now the low point was the third quarter of 2023.
Is there any signals or trends that differentiate this downturn from the previous downturn?
Well, so the last time we saw a sustained downturn in M&A was sort of post a great financial crisis. And, from a level of activity standpoint, it kind of feels similar to the 2012 to 2016 timeframe. I mean, companies were, at the time, were risk averse. They were still, the shock from the financial crisis had not worn off. The activity wasn't terrible during those years, but it was just kind of bumping along pretty lackluster. And that's kind of how it felt the last couple of years. Executives have just been worried about the economic outlook and just not pulling the trigger on deals. But a big difference between now and then is the interest rates are higher. Interest rates were so low for so long that, even though they're coming down now, they're still very much higher, than they were, from anywhere from from 2008 until, 2022 when the rate hiking cycle began. So, with the higher rates, it just makes the M&A math more challenging.
Yeah, the interest impacts it. Cost of money goes up, then people think twice about the terms of their deals.
Certainly.
Given this recent report, what are factors that are driving the increase in global M&A announcements, and what headwinds are still slowing growth?
Sure. So in 2024, we did see an increase in large deals. It really started in late 2023, the fourth quarter. There's some large oil and gas deals then, and then it carried over to 2024. There were 11 deals that had a value over $10 billion in the first quarter of 2024. And going back to 2018, there were only 3 quarters that had more deals than that, above $10 billion. And then those quarters it wasn't a lot higher. It was 12 to 14 deals, in those quarters. So it was a pretty big, start to the year for large deals last year. And the number of large deals did slow as 2024 went on. And again, I think that was part to do with the U.S. election. As the election neared, the number of deals slowed down, but activity picked up almost right away. Prior to the election, the U.S. had been the driver behind the increase in large deals, which I kind of thought that was interesting, just because there was so much increased antitrust scrutiny from the Biden administration. It was kind of surprising to see those deals come to market. So under a different regulatory regime, the growth could have even been even higher. So that was certainly a headwind in 2024. And again, just the higher rate environment is also certainly a headwind.
Regulators and interest again.
Yeah.
From your perspective, what's currently missing from M&A activity? Are there areas where deal makers should be particularly focused or vigilant?
Sure. So what I would say is M&A is just not quite firing on all cylinders. You've seen pockets of growth and spikes in certain areas. For instance, M&A activity in Europe jumped in the second quarter, but then in the second half of the year, it fell down. The opposite was true in Asia. Activity was slower in the first half, but picked up in the second half. What we didn't see in 2024 was them increase together and stay up. It was kind of offsetting each other. So, we kind of saw different sectors. We kind of saw something similar in the U.S., when looking at different sectors. Some colleagues of mine, they work for a team called 451 Research, and they do a ton of work on M&A in the business IT innovation space. So they focus on tech M&A. Something that they have been highlighting is how some serial acquirers, some tech companies who have been serial acquirers in the past have been pretty much sidelined recently. One interesting stat that we had in the M&A Outlook paper was that Microsoft, Adobe, and Oracle collectively spent $78 billion across 99 deals between 17 and 21. And each of them did a small deal in 2023 and then were silent in 2024. So, they were pretty much sidelined. But other areas like oil and gas was very active. Again, just not firing on all cylinders there. Something we've been hearing a lot of chatter about is the lack of private equity activity, and it does kind of seem like there's a turn there, and things might be picking up from the private equity standpoint. PE has a ton of capital to put to work, and and we did see in 2024 we did see a number of large deals from private equity firms. It was one of the most active years it was one of the most active years for private equity backed M&A transactions of $5 billion and up, and also a lot of what we do is we listen to earnings conference calls of executives, and over the summer it seemed like there was a bit of a tone shift from private equity. Our private equity news team puts out this sentiment analysis that's sort of based on language used by executives and analyst earnings calls, They look at Apollo, Blackstone, Carlyle, KKR, and pretty consistently, their sentiment was trailing, was their average net positivity sentiment was trailing the S&P 500, but in the third quarter, it pulled even. It got decidedly more positive. So I really think what was happening there was private equities was kind of waiting on the sidelines, for a change in the rate cycle, and then once it came, and then it kind of, their tone sort of shifted on the deal activity.
So we've seen the Fed recently pivot to lower rates. How do you see this impact acquisition, financing, valuation?
Yeah. I mean, it's certainly a catalyst for M&A. The net take home is that the bid-ask spread just narrows. And that should definitely facilitate more deals. It just lowers the cost of acquisition and financing, which gives buyers more wherewithal, and that could certainly, boost valuations that the sellers receive. And we have seen evidence of it already. Headed into December, our data shows that the implied enterprise value to EBITDA on global M&A had really stepped up, to what it was earlier in 2024. And actually, by the end of 2024, it was pretty much close to the 2021 levels, which when I kind of did a double take when I first saw that, but yeah, it was pretty interesting how quickly it changed.
Interest goes down, EBITDA goes up. What should M&A practitioners consider in terms of financing strategies in this changing environment?
Yeah, I mean, what I would say is explore options. One of our big picture reports focuses on credit, and in there, I didn't work on that report, but we have a talented team who put it together. And what they were talking about in there was how the overall credit market is growing and new structures are developing. We saw, obviously there was a proliferation of private credit funds, that have come to market in the last few years, but now we're starting to see more partnerships. Citigroup and Apollo had, announced a $25 billion fund, so that's an example of one of those. So, and the private market is just, it really helps companies that may have otherwise faced, unfavorable terms, in the public markets. So so it can bring together alternative arrangements. So private credit also kind of stepped in because banks had stepped back recently in recent years, and banks had been tightening their lending standards kind of after the March 2023 liquidity crisis. And they were pulling back because there was concern about credit quality getting worse. And that really helped the private credit funds, sort of fill the gap there, But what's happened though, the deterioration in credit really hasn't come to light. Banks have been in pretty good shape. So I do think banks are going to get more aggressive on the lending front, and because they're looking for loan growth right now, banks. So I think that just kind of will give companies more options out there from thinking about financing.
With all these private credit funds, because you had a good point, there's so many of them now to like every level, whether you're doing a really big deal or even a small deal. Do you think that's going to tighten up?
Well, I mean, definitely the increased competition it will make it more challenging, for them, But I mean, the fact that banks are trying to do those partnership, funds. I think there's interest in keeping some of that going, along the lines.
Your report highlights a recent drop in equity issuance. Could you share insights into the investor sentiment behind this? Are there any indicators for a rebound in IPO activity?
Yeah, so we did start to see some pickup in IPOs during the third quarter of 2024. For U.S. IPOs, the total value raised in the third quarter was higher than the previous 2 quarters, and which was kind of interesting because normally activity slows during the summer months. The bulk of the activity came in July, and in August, volatility spiked. We had that weaker than expected jobs report, and there was a hawkish tone out of the Bank of Japan. So after that volatility spike, then the IPO market sort of became a wait until next year story. We had the pause around the election, and then then once you roll into the holidays, everything is just the windows to IPO are smaller. So, but to answer your question, I really do think 2025 we'll see a pickup. It's just been quiet for way too long there, and there's a lot of pent up demand where we're going to start seeing some steady growth to the IPO market.
From what you've seen, how does volatility affect corporate buyers' approaches to equity financing and public market exits?
Yeah, I mean, the volatility just makes everything more tricky. If you're, the demand for shares, if you're trying to exit, might not be there, and the pricing might not be at the level that you're looking for. If you're doing a stock transaction, and you get the price right, the buyer stock, investors could reward the buyer stock, and then both the seller and the buyer could actually see some benefit from it. So volatility definitely has an impact on equity deals, but also the volatility also has a significant impact on M&A deals in general. When there's volatility, executive confidence just gets weakened about the economic outlook. So I mean, at the end of the day, volatility is just not good for all transactions, I would say.
So it sort of gives a bad taste on the appetite for doing public to public type of deals, and then like even delaying some of these IPOs.
Absolutely, yes.
Asia Pacific saw notable deal activity growth that you mentioned, while Europe faced political and regulatory uncertainty. What can corporate M&A leaders learn from these regional dynamics?
Yeah, well, I think the point that we were trying to make in the report was that the M&A recovery has been, a bit uneven. Even though Europe had a very strong second quarter, but it came back down. And it was offset by the growth in the Asia Pacific. So to me, it just seems that corporate M&A leaders are being selective about the deals they pursue. It's not 2021 or 2007 where it's just deals everywhere. It's just finding the right transaction and pursuing them.
Do you foresee cross-border M&A becoming more prominent, or geopolitical concerns still holding things back?
Sure. A big question is how tariffs will impact the market. We're expecting to see the Trump administration, utilize tariffs more again. There is a school of thought out there that tariffs can lead to more deals inside the U.S. The thinking is that companies based outside the U.S. will look to do deals inside the U.S. to avoid tariffs. But it's sort of, once you get into this era of protectionism and trade wars, regulatory approval can become more challenging. So, larger companies might be able to feel like that they have the resources to withstand, a drawn-out regulatory approval process, and the expense of it. But smaller companies, might be better off sort of like turning to like joint ventures or some sort of partnerships. So it's quite possible that we can see, an increase in the transaction values for cross-border deals, when we look at the big picture, but we might just see fewer deals, because again, the bigger companies might feel like they can pull it off, while the smaller companies might, not want to, have the resource, dedicate the resources to it.
That is interesting. That just the impact of the political. That's interesting. The impact of these political dynamics, how they're going to affect corporate M&A strategies. How do you see this playing about, like more specifically, domestically and abroad?
Yeah, definitely. Elections do matter. They definitely, and government certainly plays a role and can impact M&A. But what I would say is that overall, the economy is the biggest driver to deal making. M&A slowed down during the early part of the Obama administration, but that was driven by the fallout from the great financial crisis. M&A slowed down in the early 2000s during the Bush administration, but that was fallout from the dot-com boom, bust, excuse me. under the Biden administration, the slowdown was largely driven by the need to raise interest rates to combat inflation. However, there is no denying that the Biden administration has been more aggressive in challenging mergers and making and sort of drawing out the process. They brought up some novel arguments. Some of the smaller deals under the Hart-Scott-Rodino Act. Some of those processes were drawn out, and there was just an increase in the amount of information that was demanded in sort of second requests. So and this had a chilling effect. For some deals. I mentioned earlier tech. Large tech deals. There's certainly we certainly saw fewer deals come to market there.
There is definitely a lot stricter antitrust measurements, and it sounds like that's basically I'm just like, what's your view in the current census on the issue, and any perspective on how M&A teams should be preparing for the heightened regulatory scrutiny?
I don't know how lasting of an impact the Biden administration will have on M&A. Most of their changes were about interpreting or adjusting guidelines. They didn't have a lot of success in court, so there's not much in the way of precedent set in cases. I believe with the Biden administration, there was more coordination with global regulators, and we'll probably see less of that from the Trump administration. So I think that's one thing to think about as we go forward. That being said, I don't. I think it's sort of an open question on what the antitrust it's going to look like under the Trump administration. I think the tech industry is certainly expecting to face more antitrust scrutiny. And, during the first Trump administration, we certainly did see some challenges, to deals. The numbers, didn't go down to zero or anything like that. So, I think the consensus is more along the lines of we'll kind of wait and see what happens. I mean, there's definitely everyone's more bullish on M&A right now. If there's tax relief given to companies, that's obviously going to give them more ability to make acquisitions. And if we're trying to stimulate the economy, that's also that bodes well. But I do think I'm kind of interested to see how the antitrust thing is going to play out.
Okay, it's tough to say. Like, what specific strategies are there for mitigating regulatory risk? Have you seen anything, especially with these industries that are more prone to it, like tech and finance?
So the one area that I'm most familiar with there, I would say, is financials. And one strategy that we've heard banks talk about a lot is just reaching out to regulators before announcing deals. And on their deal calls, they're telling their investors that we've been talking to regulators. We feel confident. And they're saying that because the deal it's been elongated the process, and that obviously adds expense to deals. So but reaching out to regulators, and getting a comfort level, is something that banks have been doing, before announcing a deal.
I think it's really cool how you guys analyze earning calls. Is there any insights that you've picked up from recent earning calls that could point to evolving M&A strategies or shifts in corporate priorities? Yeah, so an area where I focus on a lot is investment banks' earnings calls. And, we definitely saw or heard, sort of, a shift in their tone, as the year went on in 2024. In the early part of the year, executives were talking about how 2024 is more about gradual improvement in M&A after 2 down years. But then the outlook became more bullish as the year went on, in the outlook for 2025. And this was even but before the presidential election. And so it was just driven by the rate cutting cycle. And again, it's not just corporate activity where there's kind of being more bullish. They're also talking about an increase in private equity activity. The headwinds that they keep talking about is
is sort of the global conflicts around the world and just the closing times being elongated. But the private equity piece is really interesting because just the increase in private equity and how much of an impact that they have on the overall deal environment. It's pivotal for the investment banking business.
That's really interesting that you extracted that. What one of the things that your report mentioned was that the banks are very much focused on recruiting. Like what indicators would you pick up from that in terms of like the broader landscape?
Yeah, so what tends to happen during the slower M&A times is the advisory focused firms, the firms that are just focused on M&A and providing advice, they tend to pick up more talent in the slower times. The larger bulge bracket firms are cutting costs, and that can lead to some talent becoming available. Also iBankers have a little bit more flexibility to move around when there's less deal activity. If you're not working on anything that's imminent, you're in a better position to move and sit out that period of time on your garden leave. And for the hiring company, the hope is that the new hire can get set up during the slow time and is ready to take advantage, when the activity picks up. So, I was something interesting on the Moelis on a recent Moelis earnings call. The CEO was talking about how headcount can get elevated during slower M&A times, and just because you need more staffing to service clients, who have deals that are stuck in the pipeline. He was saying that, we take on an assignment, and 18 months later, we can't just drop it. We have to have people to service that client. So I definitely kind of think that the headcount gets a little bit more, goes up, during the slower times, and then once the for those advisory focused firms, and I think they just view it as a time to pick up talent.
What are some practical takeaways that corporate M&A teams can use to prepare for the upcoming year?
The assets that you covet that are backed by private equity, check in on them. Our private equity news team, recently put out a chart that showed the average holding period for a buyout portfolio company was at a 10-year high in October. So, those private equity firms, they need to move those assets, so, they have LPs that want to see some capital returns, and the lack of capital returns that they're giving those LPs, that hinders their ability, to raise new funds. So, I'm not suggesting that private equity is going to be, selling everything, but it seems to me that now would be a good time to reach out and just and see where they're at with some of those portfolio companies that they've been holding on to a long time, and maybe they could be looking to move them.
I think that's a great tip. Do you have any predictions for how M&A deal structures, financing, or even diligence might evolve if we move into 2025?
Again, I think it just goes back to private equity on the deal structure side. Whether it's exits or entries, I think it's going to be a more active year for deals involving financial sponsors. On the corporate side, I could see more growth-oriented M&A happening for the last couple of years. From my perspective, at least, it seems like it's been more about consolidation and divesting non-core assets. I think that's largely a reflection of companies, not having confidence about the economic outlook and trying to sort of build a moat around their core business. It seemed like for a period there, we were just like constantly talking about when the recession was going to happen, and that's not a great time to be looking to expand it to a new area. So I could see companies looking to sort of get back to and looking for avenues to expand and build onto their existing business.
I hate to sort of summarize everything here. What are the areas or emerging sectors you see are going to get the most activity in 2025?
Yeah, well, I think the easy answer there is AI. Our 451 team, put out an outlook report, that interesting stat. They were saying that through the third quarter of 2024, quarter of the tech M&A value involved a target with machine learning capabilities, and that was up from a fifth the year before, and 10% in 2022. So, just more deals, AI is more going to be a part, of M&A going forward. I can see that certainly growing.
All in on AI. Any recommendations that practitioners can position themselves to capitalize on AI opportunities?
Yeah, I mean, I guess what everyone's kind of trying to figure out is how to get value out of it. Obviously, we have the hype, but a point that they made in that paper was just that, customers and clients are going to expect it, so, it just helps with that level of service. So, figure out, I guess don't overpay is sort of the advice there.
Yeah, that's a fair point, is really try to get predictable on how you're going to monetize it. Right. So far, I think my biggest takeaway is the data point on the private equity firms of just highest hold period, which kind of gets me thinking to double down in looking at the portfolio of PE firms and starting to refoster some of those relationships.
Sure. Yeah. Like I said, I definitely see. They're hearing it from their LPs. So,
not to put too big of a commercial plug, but do you know any good tools that you can start analyzing companies and private equity portfolios?
Well, you can certainly do that on our platform. We have a pretty good breakdown of PE firms and where their portfolio investments are and by sector, and then you can drill down and look at when the investments were made, and it definitely gives you some idea of the holding time and what may be something that may be ready to exit.
I'm going to test it out so I can report back to the podcast listeners here. Hey, Joe, one last thing I got to ask you is, what's the craziest thing you've seen in M&A?
Craziest thing, I guess for what I do, the craziest thing I've seen is just, during COVID, there was a second quarter of 2020, M&A just came to a halt. It just stopped, and then it came roaring back to life, but when it halted, I remember, I think it was like April 2020, listening to Evercore's earnings call, and the CEO was just talking about how he didn't know when the appetite for M&A was going to return. And when you hear executives talk like that, you definitely take notice. But later that same quarter, M&A just picked up and it came back with a vengeance. The third quarter of 2020, it was over $900 billion in global M&A activity, and then we just went on this run of $1 trillion quarters just for a long time, and it's just crazy to think back, like how it just stopped, and then it turned on a dime that it was again roaring back to life.
Yeah, it went to like a full sprint, dead stop, full on sprint.
Right, and I'm sure you've had these conversations with iBankers, but they talked about how they became more efficient during that time just because everything was done over Zoom and trying to, you didn't have to travel everywhere, so it kind of sped up the process in some ways.
They did a little bit. I think most of them are still using Excel to run all their billion-dollar deals. But more on that later. This is a fun conversation, Joe. Thank you so much for taking the time, helping me become a better M&A scientist.
Yeah, I had fun as well, so thank you very much for having me.
Fellow M&A scientists, if you got through this, I'd love to hear your feedback. This is the first time I've got to interview journalists and base an interview off some data points. Love to hear if this was helpful. If not, you can tell me that. I'm open to the criticism because that's how I know to do more of these interviews or not. So reach out to me, usually LinkedIn or the email somewhere in the footnotes over here. There's also a good way to reach out. Till next time, here's to the deal.